Hello everybody and welcome back to another episode of P.I.P, People in Property. Today we have my good friend and mortgage broker Sam, who actually we used to work together with a little while back. So Sam and I met nearly 10 years ago now, maybe a little bit longer, while I was still a lettings manager at the beginning of my career in Catford, and he joined us as a mortgage broker in within the team. How are you, mate?
I'm not bad. How you doing?
Yeah, good, thank you. Thank you for coming down. Nice to see you for a little while. Obviously we've been busy with our families. You've got 3 kids now. I've got 2, but times have been good. How have you been finding the market and business?
I think just like with anyone else at the moment, with the market itself, I think we hear a bit of a turmoil around about October when Liz Truss decided to obviously dump some news on the economy. But I mean, we have since seen, since the turn of the year, a bit more of a recovery, a bit more stability in the market. I think there's probably more of an understanding from the consumer that this is probably going to be the norm. Cheap money probably isn't the norm anymore.
No.
We've kind of enjoyed that period over the last 8 to 9 years or so. We're now kind of in a different phase, which we will class as a bit more kind of normality in the market that we've been accustomed to kind of years before. So I think, in my view, is that the market is starting to recover again. But again, you know, it's always turbulent. You can't always predict what's going to happen in the future.
These are difficult times, as you say. Before we sort of get a bit more deep into it, I just want to sort of quickly bring it back a little bit. Actually, I forgot to do this at the beginning, but let's bring it back now. Because you originally wasn't a mortgage broker. If my memory serves me right, you used to be a teacher.
Yeah, your memory's too good. That's the problem. Yeah, so I used to actually teach in a primary school myself. Initially, it's great. I love working with children, but I didn't feel there was the financial reward there for the kind of work and effort you put into it. So I wanted to originally become an investment banker. So I would have had to study my chartered financial analyst. Fast forward, I realised the kind of studying period for that will take a good 2 years full on, and with a family behind you, it becomes quite hard and a full-time job. So I thought, what's the easiest way of me getting into the mortgage, into the finance industry? And I hate to say it was mortgages, and I went and self-studied the C.M.A.P myself, and you know, within a matter of, I'd say 2 months, I got certified, passed, and then I was knocking on the door of Countrywide, and our good old sales manager back there, Nick, who gave me the opportunity to take my first sales role into the mortgage.
I think he set up his own sort of estate agency. He set up a new, well, not new brand, but it's been a while now. I think he's part of the Sterling Acquaintance group maybe, or something like that. Was it Nick Dunning, was it?
No, not Nick.
No.
Nick Savage.
Oh, that's it. I beg your pardon. So we're talking about different Nicks here.
Yeah.
But hey, yeah, so I remember, yeah, so it just goes to show, guys, the reason why I wanted Sam to sort of touch base on that is because it goes to show that, you know, what your career is doesn't sort of define you. Doesn't define where you can sort of go, because at the end of the day you can change your path when you're at any given stage. It took you 2 months to, obviously you have to have you have to have the want of it, you know, you need to want to be able to do it, and you sort of crack down, you put your head down. Within 2 months you qualified within the C.M.A.P courses, and you became a broker, and you sort of joined the Countrywide team at the time.
Yeah.
So obviously that was a change there for you, and a challenge, but obviously every challenge has its reward, and you sort of started progressing from there. So what after obviously we went our separate ways after that, because I ended up going from Catford, from being a lettings manager to becoming a branch manager in Beckenham. Tell us a little bit about what happened from, you know, what was the steps that you took after that?
So I was at Countrywide, I think about 13 months or so, and obviously, you know, Countrywide does really kind of teach you the kind of foundations of understanding like a mortgage, but then I ended up going to NatWest, and I started working for their flagship branches in the city. So predominantly I used to deal with more kind of high net worth clients, people in law firms, accountants, private banking customers that used to work for private banking managers. So that kind of gave me a good footing, and I think what probably the difference between kind of Countrywide and NatWest is, I think NatWest allowed me the time to really understand the mortgage and different type of customers and their circumstances, where Countrywide you get similar type of clientele, I guess because of the area we was in. Normally you get kind of working class families, you know, 2 people with decent income wanting to buy a £500,000 property, whereas, you know, when you worked in a bank branch like NatWest, you get people from all walks of life that kind of really allows you to be more detailed in understanding different backgrounds and different circumstances. So I was there for about 2.5 years. I progressed really well within there, enjoyed my time there. But I knew the market is more predominantly broker based. You know, pretty much 85% of mortgages are done for a broker. About 15% is done direct through branch. And over time, you know, it would probably move more towards becoming a 90% broker, 10% direct to branch. I mean, we're seeing branches already closing down. It's just the way the industry is moving towards.
And just to touch on that, people that don't understand the difference between going to a broker and going to a bank directly, a broker has, well, not all brokers, but majority of brokers have access to a wider range of the market.
Yeah, correct. So a broker will have access, and look, a broker's job is there to give you a similar service in terms of your advice, recommendation, but also to fundamentally find you the cheapest deal, the right deal as well, right? So it's not hard as a consumer for you to be able to also go online and start searching your deals, but what you don't realize is the detail is in the devil in itself. Every lender has a specific criteria, and fundamentally a broker's there to try and save you time from having to do that research yourself, because often you might get it wrong, and B, try and save you money by finding you the best deal.
Yeah, and most people, I think as well, unless they're sort of seasoned investors, like first time buyers, they haven't got a clue about the non-high street banks, you know, like I don't know, like Skipton Building Societies and Birmingham Midshires, and you know, all these other companies that the building societies, and then not like the Barclays and the Santanders that sort of people see day to day, but these other lenders can offer sometimes, but offer better rates, better incentives, better terms, and put you in a better stead foot-wise to increase your investment and your portfolio as such.
Yeah, correct. And not just that, some of these lenders will also lend you more money. You know, some of them are kind of more unrestricted when it comes to kind of your loan to income. Typically, most lenders out there will apply 4.5 to maybe 4.75 times when it comes to loan to income. Obviously, they assess your debts and your commitments in the background as well. But there's some niche lenders out there that people won't have heard of. And we're getting a lot more digital lenders coming through as well. But they will stretch you to 5.5 times. Even some will go up to 6 times, depending on your circumstances, if you're a professional or not. So it just allows you to then potentially buy that next home that you was potentially looking at sooner rather than later, because you can stretch your income slightly more. But then again, you wouldn't know that unless you speak to a broker who can help compare that for you.
Exactly, because they sort of look at, like you say, they look at what your expenses are, if you've got children, and all those other little niggly things that sometimes you might not even take into the consideration. So that's moving on from your first home to your next home. Let's say your family's grown, you've outgrown the space, which I remember you did at one stage as well, you know, and you was like, look, let's move to the next stage, but you've got the know-how, so you know what to do. So guys, if you're watching this video, you don't have the know-how, you don't know what to do, contact Sam or contact ourselves, and we can put you in touch with brokers like Sam and his team that can assist you along this journey and on this path to basically show you what you can potentially do. Now, touching back a little bit as well onto like first-time buyers. Now, obviously the market's changed a lot. Interest rates have gone up. Circumstances are changing for a lot of people. What would you recommend first-time buyers do? Because one of the forefront things in my mind when it comes to a first-time buyer, again, which people don't necessarily know or have the know-how for, is their credit. You know, taking out loans and stuff like that, defaulting on loans, getting CCJs or IVAs and stuff like that, and then thinking, yeah, I'm going to go and get a mortgage now. Yeah. It's going to be nigh on impossible. Well, not impossible. You might find a lender that's going to charge you double the amount. But can you touch on what the best thing for a first-time buyer is to do?
Yeah, sure. So lenders will generally look at your last six years of credit history. So, I mean, you can pull out your credit report from Check My File, Experian, Equifax, and when you kind of look at the history of your credit, they always look at your last 6 years. So, in hindsight, you want, in theory, if you want to be classed as a very kind of clean customer where you can pretty much access every lender on the market subject to your deposit, is you'd want to have 6 years clean history. Now, appreciate some people might have had circumstances in the past where that caused a bit of an issue due to unforeseen circumstances. Some people might have lost their job due to COVID or divorce, and you know, circumstances happen in life. But it's then how you proceed forward in terms of improving that credit. So taking unnecessary debt is something I'd advise against. What I would suggest to people, and one way you can build your credit, because lenders want to see that you can maintain credit, is if you take a credit card, you pay it off every month. So what I used to do myself personally is I used to have a credit card and I used to just use it for fuel, right? Okay. Because then I'll just have the direct debit set up every single month that clears it every month, because I know that will just build up my credit quick.
You know what you're spending. You're not overspending.
Correct, yeah. I mean, as long as I hid it from my wife where she could get access to it, was all absolutely fine. So I used to just spend it on petrol because I knew that I'll pay it off every month. I weren't unnecessarily spending on it. and it will just build up my credit. So as long as and again, it's you've got to be very disciplined when it comes to taking out credit, because it's easy for you to be enticed by a lender to take even further credit. And they do it, right? I get my bank still, despite the fact I've nothing, throwing me more money. I'm like, I haven't even used the money that you guys have offered me in the first place. I've got a credit card balance. I want nothing on there, but yet you're trying to increase my balance. And they will and try and entice you in that way. And, you know, some people will need the funds for certain circumstances, home improvements, maybe they want a dream holiday, wedding, whatever it may be. But as I said, where you can avoid taking out unnecessary credit as a first-time buyer, don't do it. But take out a credit card, as long as, again, take this from my advice, as long as you're paying it off every month, you should be fine, and it will help you build up your credit sooner rather than later.
Yeah, you don't want to be taking out credit cards to go on holiday, and even that, you said, like a dream wedding and stuff, you need to make sure that you can pay it back.
Correct.
Yeah, so if you haven't got the means to pay it back, then I personally would stay well away from it, because that will turn into sort of like a spiral and effect. So, you know, oh, it's all right, I'll pay it next month, or it will catch up with you.
It's an addiction. Some people, unfortunately, because they've got access to that money, right? It's like if someone was to put £500 in front of you today, you would sit there, pick it up, and be like, a lot of people will go and spend that money quick. We don't realise
it's not their money to spend. Essentially, they might be loaning. It's a loan to you.
It is a loan
today,
correct?
So yeah, I think that's a very key tip that you said. So if you want to build credit, guys, and you don't know how to build the credit, get a credit card, but stay within your means. Once you come out of the means, you go into a sort of turmoil spiral effect. Get CCJs. Yeah, and that lasts for 5 years anyway. They look at your 6-year credit history. You're not getting on a ladder. You're not getting a mortgage.
Yeah.
So first-time buyers, please be cautious. Please be careful. Again, get some tips and advice.
Yeah, and it's not to say you can't get a mortgage right away, guys. I'm not here to try and put people off, but it just means you'll be paying more for your mortgage, because you'll be classed as more high risk from a lender's perspective if you can't maintain your debts and your credit that you've got in the background.
Yeah, perfect. I threw that in there because I sort of said something I shouldn't have said there. They can't get a mortgage, but no, you're right, you can, but the interest rates will be high. So that's we touching on sort of first-time buyers. Now, for people that have sort of already bought their first property and are maybe thinking, I want to do the place up, or, you know, I can't afford to move as such, maybe want to do an extension, add a loft conversion. Can you touch on, you know, how you can do further lending from there?
Yeah. So there's a couple of options here. Now, I think what we need to understand is a lot of customers or consumers out there will be tied into a decent deal, and the rates you're looking at today, you know, a lot of people will be coming off on a payment shop. So if your deal's coming up for renewal, the cheapest way of obtaining that credit is when you're doing a remortgage, as long as it's sustainable based on your income, based on affordability, you raise the additional funds of your remortgage, and therefore you'll be tied into one rate with the new lender or your existing lender. Fundamentally, if you're already tied into a deal, you can look to do a further advance with your lender. And again, speak to your broker first. If they've helped you out, always go to your broker to see how they can assist and help before going direct to the lender. And, you know, if that's not one option, because there are some lenders that won't do further advance for, depending on what you're looking to borrow those funds for, or there could be an affordability issue, there is also an option of secured lending, which is what you call second charge lending. Now, I don't advise that as the first option, but again, if someone requires the funds, it still probably work out cheaper than a loan potentially over a short-term period, as long as you pay it off when you come to remortgage at a later date. But a lot of people will take it because it keeps their monthly commitments low as well, allows them to maintain their lifestyle. So ultimately, a broker will guide you through that. It will be kind of pretty much like the last option they will consider for you, but it is an option out there, and it will keep your monthly payments lower than you going to get a £20,000-30,000 loan direct with a lender.
Yeah, and it's better than going to try and get a bridging loan, because bridging loans can be very expensive. You know, you have percent in, percent out, maybe 2 or 3%, like we've spoken to other people, and then you're paying monthly as well. And if you haven't got the money coming in, you're getting a bit of a pickle there as well. So no, that's brilliant. That's great little insight there. Now, we've touched on sort of further lending. We've touched on first-time buyers. Mm-hmm. How about for people that now are homeowners? You know, they're doing all right. They've saved some money, and they're sort of thinking, let's look at the buy-to-let side of things, because things have changed a lot. Let's be honest. Rates are now almost double what they were. So it's tough out there. I mean, I remember like just under and just over 2%. Now, I mean, I've had to remortgage one place, and it's over 4%. So.
Don't blame me for that.
No, we'll blame the politicians for that. We'll blame the politicians. But now, look, would you say the buy-to-let market is dead, or would you say that it's still doable? What's your personal opinion?
I think that there's a couple of views on this, right? So, I know the government are moving towards, tightening up on buy-to-let landlords, and the reason for that is they want more property on the market for people to be able to purchase as a residential. But it's still pretty much a sound investment. I mean, you ever look at a life cycle of like a property, like the property purchase prices, and when we've had like the crash in 2008 or kind of back in 92 in the early 90s, the market cycle normally recovers after 2 to 3 years. So you'll naturally build a bit of equity within the property as long as you maintain that property for a longer period. Now, what we are now seeing in terms of the change of direction is we'll probably start seeing more landlords buy new build properties.
Right.
Because of the EPC rating and all that's going to be coming in place in 2025. But we'll also see more landlords buying it as a limited company under an SPV. And the reason for that is because of the tax benefits you get. Now, lenders will charge a slightly more increased rate. Obviously, they're going to want to benefit as well.
Experience that.
Yeah, there you go. But in terms of, especially if you're like a basic rate taxpayer or high rate taxpayer, long term, that is probably going to be the way to go.
And just for the viewers out there, just to sort of explain to them, an SPV basically stands for Special Purpose Vehicle. And that's basically just a limited company that you set up to purchase a property in.
Purchase, buy, sell, rent a property. It's for property purposes, essentially. So there's still, if you buy under an SPV, Special Purpose Vehicle, there is still, fundamentally a lot of landlords that are looking to invest down that route now rather than in personal name.
Definitely. Obviously, that's basically for the tax implications, because Sam did say obviously the lending's a little bit more expensive, but again, you get tax benefits on that. This doesn't mean, though, go and sell the property that you own in your name to your company, because you're paying stamp duties, and obviously I'm not the financial expert here. Sam is, obviously, so you need to come and speak to him. So this isn't advice from me. This is just like experience that I've had myself, and sort of like a recommendation of things not to do as such, or to do. So obviously, if you have things in your personal name, try and retain them if you can. Obviously, if you can't afford to retain them because the rental income doesn't make you afford to pay, if it's like, for example, a lease property and you have your service charges, your ground rents, and then you have your mortgage to pay, and you're sort of breaking even, it might be worth selling that property and then re-entering it, but buying under an SPV. So there are different avenues and routes to go down. But if you can afford to retain it, don't forget, like Sam said as well, we go through a cycle. So if you can keep it even and break even at the bottom of the cycle, it's going to come back up. It might be in 2 years, might be in 3 years, might be in 5 years. But if you can retain it for that period of time, you're going to come back up and you're going to come out on top in the long run.
Exactly that. And I mean, everything's like a bit of a monopoly effect, right? I mean, rents are going up because mortgage rates are going up. So, landlords are naturally going to offset that cost onto their tenants, which will mean their tenants can't save as much as they would have wanted to. So therefore, it takes them longer to go onto the property ladder. And this is the whole kind of knock-on effect with inflation, with rates increasing, that the problem that it can cause. What I would say, though, and I'll just bring it back to kind of more first-time buyers, is that it's still cheaper for you, on average, by about £52 a month for you to have a mortgage than to rent. So, yes, we are, rates are higher than what they were previously. I think, we've gone past the kind of point of having really cheap. It's not to say you can't return back to kind of lower levels again. Lenders are kind of playing with rates. Rates have come down a lot since kind of October period, November time. So, it is fundamentally we're in a much better place than we were 6 months ago, and it can still improve, absolutely. But, as I said, when you're looking at the life cycle of you purchasing a property, you can always, there's never going to be a perfect time, because the property values are going to dip slightly at some point or increase at some point. If you're looking to live in that property for a long period of time, just by you're paying off a mortgage, which means you're building more equity in the property. It's like throwing money into your savings account. Right. Whereas if you're paying a landlord,
throwing the money away a little bit.
It kind of, yeah. I mean, everyone's circumstances are different. Some people, renting is suitable. So
we're not saying it's the wrong thing to do. No,
we're shutting down your business. Otherwise,
sat down and let it.
So we're not trying to detract away from renting. Absolutely, if you need to rent, you rent. For some people, they just need to stay somewhere short term, and that's the right thing for them.
And some people bounce around in work, so they might need to move and stuff like that. And touching base on what you said, but it works out that you save £50 to own rather than to rent. But all right, people might think, oh, that's only £600 a year. Guys, don't forget, you have equity growth in your property. So that's £60 cash flow that you're saving, but then you're getting equity growth. So, all right, the property might not increase in value for a year, but 24, 36, 48 months later, you have an equity growth. And that equity growth isn't £600. It's like 6,000, 20,000, some cases 60,000, 100,000. So that's where the game changes, and that's where it allows you to become a landlord potentially, or then go sell, release equity, buy another place, buy a bigger property, and move up the ladder as such. So don't think, oh, £50, that's not really, I'll stay renting and stuff. Or by all means, I'd love for you guys to rent. We do lettings, we manage property. So, and obviously people's circumstances are different.
Yeah.
But there is something for everyone, basically, what we're trying to get at.
There's options. So just explore those options is what we're saying.
Yeah, exactly. So, guys, we've touched on first-time buyers. We've touched on moving on from your first home to your second home. We've touched on buy-to-let investments, further advances for home improvements. Look, Sam has the knowledge. Sam has been doing this for, is it over 10 years now? Yeah, so roughly 10 years. And he's gone from being like one man doing it himself at a company to managing a team. So he's got people that he can delegate to as well. And we'll plug all his information in the comments below. But look, thank you very much for watching. Sam, thank you for coming on. I really appreciate your time. Do you just want to quickly plug the company that you work for?
So I work for better.co.uk. So we're one of the digital online brokers. I'm first out there. It's a great online platform from like a user experience. You get the kind of the online journey, easy fact finding, but then you also get the element of having a personal advisor that's going to look after you fundamentally from when you're ready to proceed. So if anyone needs a mortgage, or if it's a first-time buyer, landlords, go onto the website better.co.uk, sign yourself up, and we'll be able to take you.
And guys, I'm not just saying this because he's my friend. I've used his services. I've personally taken mortgages out with the company that he works with. I do diversify, so I have other brokers as well. But look, I like to support friends. I like to support independent as well. So hence why I use other people who have independent companies. But again, if you're looking for sort of corporate organisation that is sort of can do everything digitally for you and give you that personal approach, his team and better.co.uk can definitely help you. As I said, we'll plug all the information below, website, socials, all that kind of stuff.
And it's free as well.
There we go.
It's free. We don't charge a broker fee. So for most people out there, depending obviously certain circumstances, but we tend to be free for most people.
And even if you don't use their services and you've called them for advice, they're not going to charge you. Obviously, it will be good to follow through and use them. Because obviously they need to get paid and earn some money at the end of the day. But thank you very much for watching. Thank you. Don't forget to like, subscribe, leave us a comment, and let us know your thoughts. And if you've got anyone that you'd specifically like to see on this show next, let us know. Thank you.